this video, we delve into the insights shared by renowned economist and financial expert Jim Rickards in a recent video. Jim Rickards provides a unique perspective on the dynamics of the gold market and its connection to the US dollar. He emphasizes that when people discuss the price of gold, they are essentially talking about the dollar's value. Gold, being an element, remains constant. It's the dollar's value that fluctuates. Rickards explains how understanding the dollar price of gold can provide valuable insights into the strength or weakness of the currency. Throughout the video, Rickards touches on various economic topics including inflation, the Federal Reserve's policies, and the ongoing debate about the transitory nature of rising prices. He also highlights the importance of diversification in investment portfolios and the role it plays in hedging against economic uncertainties. In this detailed video, we'll break down Jim Rickards' key points, offering expert analysis and context to help you grasp the significance of his insights. So, let's explore the relationship between gold and the dollar, the future of inflation, and the role of diversification in your investment strategy. Jim Rickards starts by clarifying that when people refer to gold going up or down, they are actually talking about the dollar's performance. When the dollar price of gold increases, it implies a weaker dollar, and when it decreases, it signals a stronger dollar. Rickards suggests that understanding these fluctuations in the dollar price of gold is more informative about the currency's strength or weakness than about gold itself. He further advises viewers to use the dollar price of gold as a thermometer for assessing the currency's health. Just as a doctor takes a patient's temperature to gauge their condition, investors can look at the dollar price of gold to assess the dollar's strength. Rickards also emphasizes that central bank currencies and fiat currencies tend to weaken over time due to historical patterns of inflation, making it essential to focus on the long-term forecast for the currency when evaluating gold as an asset. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
When people talk about the price of gold, and I'll just use US dollars as a benchmark because it's a good global benchmark. It could be Australian dollars or any currency. People say, well, gold went up, and then they say gold went down. But gold really didn't do anything. Gold is an element. It's atomic number 79. It's a very nice, very attractive metal. What changed was the dollar price. That's what people mean when they say gold went up. They mean the dollar price went up. And if they say gold went down, they mean the dollar price went down. But what does it really mean? Is that telling you something about gold, or is it telling you something about the currency? And I would say when the dollar price of gold goes down, that means the dollar got stronger. Each dollar buys you a little more gold. And when the dollar price of gold goes up, I would say the dollar got weaker because each dollar buys you a little less gold. When you translate it into weight, I always think about gold by weight. That's why I keep talking about tons and so forth, metric tons. So fluctuations in the dollar price of gold tell you more about dollars than they do about gold. It tells you about the strong dollar and the weak dollar. So as the dollar price of gold goes up, what it means is that the dollar is getting weaker. Now, so if you want to know the dollar price of gold, just do a long-term forecast on the currency, and you'll get to the dollar price of gold very quickly. So when you say, is gold a good asset? Is it a good diversifier? Is the price going up in the long run? Great questions. And the way I think about it is, well, what's going to happen to the dollar in the long run, up or down? Well, what's the history of all central bank currencies? What's the history of all fiat currencies? What's the history of inflation? They all go down over time, not all at once. And that's another source of confusion because people look at, well, the dollar-euro cross rate, or they say euro to dollar cross rate, is the most heavily traded liquid foreign exchange cross rate in the world by far. So, and in the past, say 2 months, a little more, the euro has fallen from about $1.20 to today it's about $1.13. That's a significant decline in the value of the euro and a significant increase in the value of the dollar. So a lot of times when people say the dollar is stronger or weaker, they're actually not thinking about gold along the ways we just discussed. They're thinking about some dollar index. But if you peel back the layers of the onion for every index, Dow Jones, Bloomberg, Fed, it's all basically the euro-US dollar cross rate. So yeah, there's some Canadian, Australian, and yen and sterling. There's some other currencies in there, but the euro is the lion's share. So all these indices are really euro-dollar cross rates. So when people say the dollar is stronger, well, it's another way of saying the euro is weaker. But currencies tend to trade within a range. They'll get here or they'll go here, but they're not like stocks. major currencies, they don't go to zero. I mean, Zimbabwe, yeah, but the Australian dollar, euro, they're not going to zero. But they don't go to the moon the way Apple stock or Amazon does.
Rickards discusses the topic of inflation, differentiating between disinflation and deflation. While he acknowledges that there might be periods of deflation, he leans towards the idea of disinflation, where the rate of inflation decreases. He points out that recent inflation numbers, which peak at over 5%, were partly influenced by base effects resulting from the economic downturn caused by the COVID-19 pandemic. As the economy recovered, year-over-year comparisons naturally led to higher reported inflation rates. However, Rickards notes that the real test of inflation sustainability came later in the year when the base effects diminished. He argues that the Federal Reserve's change in rhetoric, moving away from the term transitory, reflects the challenges of maintaining price stability in an economy marked by supply chain disruptions, labor shortages, and increased government spending.
They can be strong or weaker, but they tend to trade within a range, which makes them interesting to trade because you can spot those inflection points. So right now, when people talk about the strong dollar, they're really referring to the dollar value of a euro. But you could have a situation where gold is going much higher in dollar values, and that would be, as they say, the weak dollar. And yet the euro could be falling faster than the dollar. So people always look at the euro and they say strong dollar, weak dollar compared to the euro. My only advice is look at the dollar price of gold. Use that as your thermometer. Doctor walks into the room, they see the patient, they don't know anything. What's the first thing they do? They take your temperature. So if you want to put we don't use mercury thermometers anymore. They put a little X-ray thing on your head, but whatever it is. If you want to take the dollar's temperature, look at the dollar price of gold. I did say that. Now, just to be clear, I'm really talking about disinflation rather than deflation. We could have deflation. That's when prices drop. But what I was, and so I'm not ruling that out, but what I was expecting is disinflation, meaning we'll still have some inflation, but it'll get lower. So it'll go from, I think the last monthly report year over year was about, it was well over 5%, but it was the highest in 30 years. So that's kind of very hot inflation. But I would see that trending down in the coming months to 4%, 3%, kind of get back down to that, good old 1.6% where we were stuck for years during the period from 2009 to 2019. So you still have a little bit of inflation, but it's disinflation in the sense that the rate of inflation is lower than it was before. So inflation coming down, put it that way. And one of the best guys investing and financial analysis I've ever found is that the Fed, because they're always wrong, whatever they do, if you do the opposite or assume the opposite, you'll be it's a good starting place for your analysis. You got to do a little more work than that, but it's a good starting place. So I was about 4 or 5 months ago, I was very uncomfortable because my view is that the inflation we were seeing was temporary, transitory, if you want to use that word, that it would be coming down, we would get into disinflation. And I found myself in agreement with the Fed, and that made me really uncomfortable. It's like, I was wrong. Maybe I'm wrong, but so I was happy the other day when they threw transitory overboard and said it got on the inflation bandwagon. I said, okay, well now I feel more relaxed because I'm disagreeing with them, and that's a good place to be. So yes, they did get rid of that. I think, let's bear in mind, we just went through Jay Powell's reappointment announcement, and he's going to have a Senate confirmation hearing, and there's a political aspect to this. And so he didn't want to be on the wrong side of that politically, whether, I'm not saying there was some, behind the scenes deal with the White House. It's not possible, but we don't have to assume that. I think it was just Jay Powell, the Washington politician, as much as the central banker saying, okay, I'm getting beaten up over this, let's just take that off the table. But the stronger inflation that we saw in March, April, May, June, and basically through most of the summer, a lot of that were what are called base effects, meaning, so how do we actually report inflation in the United States? Well, we do it on a monthly basis, but it's year over year annualized. So take the month of May or the month of June, the month of July, 2021, compare it to May, June, July, 2020, and take that year over year increase and then annualize it kind of, times 12 if you want a little more to it than that. And that's your inflation rate.
Jim Rickards cautions that a prolonged period of high inflation could have detrimental effects on the economy, potentially leading to a recession. He suggests that while inflation remains a concern, there are also deflationary pressures at play, such as declining labor force participation and ongoing supply chain bottlenecks. In essence, he underscores the importance of closely monitoring the economic landscape to determine whether inflation or disinflation will prevail. Rickards rounds up his insights by emphasizing the significance of diversification in investment portfolios. He highlights that diversifying across various asset classes can help mitigate risks and generate consistent returns even in uncertain economic environments. While not every asset class may thrive simultaneously, the goal is to achieve a balance that provides stability and growth.
Well, what was going on in 2020? It's the lockdown, it was COVID. I mean, the US economy was flat on its back. So of course you had price decline. So when you get a year down the road to 2021, you would expect those prices to be higher, not because everything's out of control, but because the prior year was so weak. And if you're doing it year over year, which is how they do it, you're going to get some pretty hot numbers, and we did. So that was to be expected and not cause for concern. The real crunch came more recently in September, October, and now I think we'll be getting the November numbers in a matter of days. And the third quarter, 2020 third quarter, was one of the strongest quarters. We had a steep drop, and then we had the bounce back in the third quarter, one of the strongest quarters in U.S. economic history. So the base effect went away, and now you really are looking at something that's maybe a more legitimate comparison, and it was still a little hot. So then you're like, well, okay, is that COVID? Is that supply chain? Because supply chain was not as big a factor. Maybe the supply chain was breaking down a year ago, but nobody was buying anything because nobody went outside. Now all of a sudden the shoppers are back, and we're finding bare shelves again. You know, it's not just the paper goods aisle at Costco. It's one of our big box stores. It's everything. You know, and sad to say, liquor stores don't have all your favorite wines. So we're seeing supply chain effects, and that would tend to make prices go up because we have a lot of money in the economy and shortage of supply. People are going to bid up prices, and then there's labor shortage, et cetera. So there are a number of factors in play, but then it still begs the question: is it transitory, notwithstanding those factors? Because you only get COVID once, so you only get supply chain breakdown once, then it just becomes the steady state, or is it is something going to change? Now that's a big debate. There are two sides to it. I still lean to the view that the disinflation is going to get the upper hand, and part of the reason I say that is real incomes are not going up that much. This new COVID variant that's going around, I don't have to tell Australians about lockdowns, but we have our own, and that's bound to slow the economy. The supply chain is bound to slow the economy. So if prices get too high in that world, you could actually tip into a recession. So $4.50 is US dollars. I know everyone in the world thinks we have cheap prices, but a year ago, Americans were paying $2.25 a gallon for gas, and today we're paying over $4 a gallon for gas. Well, okay, fill up your tank, but that's less money for everything else, dining out, movies, clothes, whatever else you want to buy. So it hurts all those discretionary, consumer discretionary categories if more money is going into the gas tank. So you could have a setup for actual, certainly disinflation. I don't have to go so far as to say deflation. Disinflation, meaning inflation is transitory, and if it gets worse than that, you can even see a recession. Now, not right now, and I'm not making a hard and fast forecast, but you can see that trend. Now, I can take off my deflation hat, put on my inflation hat, and just look at the money supply, look at the government spending, look at the supply chain constraints and say, well, wait a second, if the government's spending trillions upon trillions in deficit spending, which we are, and there are more bills, more legislation in the pipeline, which it'll get amended in some ways, it's not final yet, but it'll probably go through with another $2 trillion of spending. That much spending in an economy where with declining labor force participation, supply chain bottlenecks, a new brand of COVID going around, what does that do to prices? Well, that might give you an inflationary boost. So the best answer is there are good arguments both ways. I don't want to sound wimpy about it, but I don't want to put a stake in the ground either. I lean to the transitory camp. I lean to the disinflationary camp. I think part of what Jay Powell's doing is for political consumption, but we'll just have to see. But again, it goes back to what we talked about at the beginning of the interview: the power of diversification. If you have that diversified portfolio, it doesn't mean that every asset class screams in every state of the world, but some of them will, and they should give you good total returns without too much risk.